All right, guys, let's get going. Thanks for attending the webinar again today. Basic rundown of what we're going to go through. Before I get into this, as always, if you've got any questions, feel free to ask them as we're going through. I'm happy to answer questions as we go through, obviously, even if it's not on the particular topic. Just shoot it out and I can go over it with everyone. Okay, what we're going to go through is having a quick look at what we can expect from the RBA next week, and then we're going to have also look at the Chinese PMI data today. And then basically tie that all into AUD, and then we're going to dive into that on the fundamental side, and then we're going to have a look a bit on the technical side, what is happening right now and why I think the AUD is looking a little bullish. And then we're going to have a look at the BoJ, JPY as well, what's happening there, what this action from the BoJ and future action might mean for the yen. And then we're going to go straight technical with NZDJPY. And we're going to have a look at some very interesting trending patterns for the pair, and same situation for EURGBP, which is just a pair I've been going for a while. And as always, we're going to keep having a look at our gold, but this time we're going to tie it back to open interest, which is still declining, so it's pretty significant for gold price going forward and sort of backs up our theory. Alright, so starting off with the RBA, this is basically what we're going to be looking at in terms of what can we expect from the RBA. What you want to look at in particular are the bank's prior rate cuts feeding into the real economy. Now, up until yesterday, we didn't really think they were. I mean, there wasn't a whole lot of data to suggest they were. Now you we have building approvals come out, and it was a lot higher than expected. So that does show that some of that monetary product loosening is getting into the real economy, but it's still very limited. And as we know, one figure isn't a true representation of the domestic economy here in Australia. So it's not yet certain that the bank's prior rate cuts are really feeding into the economy the way we want to see them. So that means, just from that particular standpoint, if we take that alone and in terms of what the RBA might do, then there's still room for movement now, in terms of or scope for a rate cut. So the key thing to look at, though, obviously, is what the market is looking at right now, which is this inflation situation here in Australia. The reason why they're looking at that is because beginning of last week, we had that inflation print, which sort of spooked the market a lot and basically caused a lot of participants to change their mind and say, all right, now the RBA is going to hold as opposed to cuts. So if we look at the figures, if you remember, I went through them last week as well, but they're pretty similar. They're pretty similar today. We went from about an 80% chance of a rate cut according to futures markets or swap markets. Now we're looking at a 50-50 call. Or if you look at interbank futures, it's even swayed in the direction of no rate cut come Tuesday next week. So that's obviously a big a big change. And if I speak to a lot of the traders on the floor, including myself, the feel is now as well there's not that need for a rate cut, especially what's happening in the domestic economy and what's coming from overseas. Because keep in mind, for there to be a rate cut, there has to be, RBA has to find a reason why they need to stimulate the economy, essentially. And if we look at domestically, to get the employment rate, yes, it's heading up, but at the same time, so is the participation rate. Now, the big worry originally with employment was the fact that even though the employment rate wasn't heading up or didn't head up significantly over the last year or so, the participation rate dropped dramatically. So it was basically people just leaving the workforce and not looking for jobs. That's not a real reflection of a nation's employment. So instead, whilst we saw, the employment rate head up last time around, we also saw the participation rate pick up, which is good news, especially because the participation was focused, as I went through, was focused on full-time employment, which is much more healthy for an economy, in a broad scope than part-time employment. So we've got full-time employment coming through, pick up in the inflation rate. That's good from an economic perspective, and the RBA will definitely look at that. But the key thing they want to look at, is that sustainable right now? And the future rhetoric from the RBA, they don't think this sort of employment situation is really that sustainable. I mean, if you look at the government here in Australia, they're going on about how we can keep employment rate maxed at 5.5% going forward. I mean, that doesn't seem that realistic, and the RBA agrees with that. They think it might jump a bit higher. But again, with this improvement in the participation rate, that's something they didn't expect right now. So that should be interesting. Also, housing is going in two directions. By housing, sorry, I mean buildings are going in two directions, not necessarily housing. What I mean is residential is going one way, and then non-residential the other way. So we've got pretty terrible conditions in non-residential, which the RBA has mentioned before. In fact, I've looked at it a fair bit. On the other side, residential, that's not looking too bad. We saw yesterday's data and some other housing data. It's actually pretty good for residential, or it has been over the last month or two, which is great. And that's basically the result of the RBA rate cuts. They're feeding into the economy, and people are starting to jump back into the market. In saying that, house prices did just come down. We just got data out this week that said they started to drop off again, and obviously that would be a concern for the RBA if they started to deteriorate dramatically, because the banks here in Australia, the big four banks, really hold a leverage to the hilt with this. With mortgages, or not leverage, but they hold a lot of it on their balance sheets. So that'll become a real concern if prices start to drop dramatically here in Australia. But they're not doing that right now. We don't expect to see that right at this moment. So that shouldn't be a massive concern from them. And on the non-residential side, there really is just massive underperformance. It's not doing well at all. We're seeing drops across the board. So from that perspective, it's a mixed bag, like I was saying. You've got residential, yes, good, but non-residential, not so good. But again, the RBA can't obviously with cash rates target one specific sector, so they've got to look at the broad scope. And the broad scope is, it's okay at least. It's not pointing in either direction massively. Now, what we saw last time around was a big focus on China. Even though at the time the rate cut was delivered, we had a statement by Governor Glenn Stevens, and he went over a few key points. The key points was economic activity in Europe, is contracting. Yeah, and that's still the case, obviously. Europe isn't going great, but over the last month there hasn't been a significant deterioration in sentiment regarding Europe, which is pretty important. And the United States, last time around, Stephen said the United States growth in the US is modest. It's still, a similar situation there now. Not much has changed. Obviously, all focus is on the election and this fiscal cliff. But again, it's too early to tell on either of those, so we don't expect that to highly influence the RBA's decision. The big one, of course, is China, especially here in Australia. So what did the RBA say last time? They said China had slowed, which was obviously true. It had slowed, and it is still slowing, at least to the recent data. But what we look at, GDP data. But what we've had out recently is, or over the last month, is better than expected data out of China, or at least as expected on the upside out of China. So today we had the PMI, which I'll go through, which wasn't great, but again it jumped it back into contraction territory, at least from the official standpoint. And earlier we had exports. Now the big problem with China, obviously, as we know, even though they're trying to shift towards this import-based economy, is they're still an export-based economy, and they're still an investment-based economy. As much as they're trying to change that, it's not changed yet. So there's still a lot of focus on China's export sector. Now we've got those export figures as we went through a couple of weeks ago, and they were pretty good. They were actually very good. 9.9% jump in exports over the month, which is a great thing. Now we expect to see that repeated next week. Actually, we've got the next figures out on Saturday next week here in Asia. So we expect to see not 9.9, but we're looking at possibly 9.3 is a consensus estimate. We agree with that. We think it might be tipped a little to the upside, so possibly a sort of 9.2, 9.1. But in any event, that 9 or above, it's a good figure, and that bodes well for the economy going forward. So, that, at least in last month, there isn't that pressure that we saw last time around on the RBA to cut rates basically because of China. So again, are they going to cut based on that? No, we don't think the pressure's there for them to do that. Now, what do we look, obviously, in the market? Like I said, it's pretty much divided. It's a 50-50 call. If you speak on the street, or by the street, sorry, I mean through the trade desk, it's the same sort of thing. I mean, people saying they could go either way just because the RBA is so historically vague when it comes to what they're going to do in terms of monetary policy. So but we're more leaning to the fact that it hasn't been enough change domestically or globally over the last month on the downside to force the RBA to act. We think they'll hold off at least for now. Obviously, if things deteriorate massively before Tuesday, we might change that, but we don't expect anything massive to happen before then. So that should bode well going forward. Now, like I said, the Chinese PMI data we had out today. This is before the data came out. Sorry, the actual data came out. It printed at 50.2. Obviously, the prior one, as we can see, there was 49.8. Now that's good. All right. Some of you might be aware the data that comes out of China, especially this official PMI, manufacturing PMI data, isn't always that accurate, especially because the official data is skewed towards certain parts of the economy that are doing better than other parts. But if we take this official data along with the unofficial data, which is published by HSBC, which came out about 45 minutes later than this data today, we see both of them heading in the same direction. So instead of looking at the actual number for these figures, because we can't take the number at face value, we don't, there's not enough information available for us to sort of just accept these numbers. And if we look at the direction or the trend they're heading, that's where we can really get some useful information, in our opinion. Now, in both cases, we're seeing the trend up, which is good. Now, we're also seeing a narrowing of essentially the gap between the two figures. We saw HSBC's figure print around 49.5, and then we saw the official figure around 50.2. So both of those, trending upwards is a good sign. Again, we take that as sort of face value, but it does bode well for the Chinese economy going forward. The key thing to look at, though, or the interesting thing, when you're looking at the HSBC's figure or the unofficial figure, is that's sort of centered around smaller export-based companies in China. So, obviously manufacturing export-based companies. Now, when we take that in consideration, we want to look closely at new export orders, just because that's a big sort of sign of the health of the export sector, especially affecting the little guy, which is really the bottom end or the crux of what the economy is feeling. So when we look at that and we see the new export orders are actually doing better than we expected. They've rebounded very strongly back into contraction territory today for the first time in 6 months, which is very good, and that bodes well going forward. So it's saying sentiment, basically those small manufacturers who historically supposed to be the hardest hit, they're expecting a turnaround. So that shows that these liquidity measures and things that we went over in the last few weeks, they're actually feeding through into the real economy. So these sort of reverse repo operations, or open market operations, and these cuts to the RRR, and even interest rate cuts, and these small infrastructure spends the government's doing around the place, it's helping, and it's feeding through into the real economy. So that gives us faith in Beijing, and that should turn us around. So again, that'll feed back to what I was going before in terms of the RBA. Decision, and might keep them on hold, should also possibly keep them on hold. But more interesting, in my opinion, is what is that going to do to the Aussie. Now, if we look at here, this is obviously Aussie USD 240-minute chart. So like I was going through on a fundamental level, this switch from pricing in a rate cut to pricing in no rate cut is obviously is a positive for the Aussie. Now, we haven't seen the corresponding price action so much in the Aussie over that time period. In fact, it hasn't really done a whole lot. Of sort of traded broadly sideways in these up and down swings. Now, that means come Tuesday, if from a fundamental perspective, if the RBA decides not to cut the official cash rate, there is definitely room for significant upside, for this pair. Now, if we look at the PMI side, again, coming from China, we didn't see a big reaction today. There's all these month-end flows, and, there's reasons why we didn't see a big reaction in the Aussie. It was tied up in other things. But that also creates the opportunity for potential upside in the future going forward, especially, like I said, if they don't cut cash rates on Tuesday, we expect to see a big jump higher in the Aussie going forward, and that should push it through some fairly big. We'll have the momentum to push it through some big order levels, depending on where it is lying at the time. So if it's lying around the current levels, that 104 level definitely looks easy to break with the sort of momentum we expect if they don't cut rates. But again, looking at the chart from a technical perspective. Now this is almost a textbook rising triangle pattern or ascending triangle pattern. that basically, that's a bullish signal for all the tech guys out there. That basically just means, we're expecting a break on the upside. And we expect to see that push through 104. Now, the key thing to look at is, as well, when we look at the daily chart, we can see here, let me just grab the highlighter. If we look here, this is obviously price action right now. It's also around the bottom of the cloud base. So what that means is that obviously we know that 104 level is really key for this pair. There's a lot of build up of orders right there. We can see that in price action. We can also see it in the orders themselves. But when we tie that into the fact that this that it's the bottom of this cloud package as well, we tend to think that 104 level is going to be big resistance. But again, once it breaks through that, it really does open the way up towards that top of that trend line up around here going forward. We think that should possibly provide some resistance before it hits 106. But again, if we do get that pop above 104 and then we see the momentum going forward and we're getting the right technicals, which we are getting right now, then there's definite push up towards 106. Whether we think it can break 106, we don't know. I mean, if somehow the pair gets up towards 106 before next week, before next Tuesday, before the RBA rate decision, and then the RBA comes out and says they're not going to cut rate, that sort of momentum might be enough to push it through 106. But otherwise, there's a lot of orders around there, as I keep saying. So, without that sort of massive fundamental push, something like that RBA not cutting, then we don't expect to see that push. On the other side, if we do see on the end of next week in terms of the export figures from China, if we do see a big jump beyond what's expected, like I was saying, around about 9.3 is expected now, 9.3%. If we do see, significantly more than that, which is a long shot, but again, it could happen. If we do see that, then that also would possibly provide, a nice push. Now, if we do get that break of 106, it jumps through those orders. Again, we'll possibly see a lot of long covering as well. So that might help the pair push up towards 108. But we're looking at that again next week as we do every week. So again, on the near term, on the 240 chart, we're looking, I think we're looking fairly bullish. I like this chart. I like price action. I like where the technicals are looking broadly, and on the daily chart as well. There isn't that strong sort of upward momentum from the technicals, but again, there isn't anything to deny the push higher, at least from a near-term perspective on the 240-minute chart, to hourly chart. All right, now if we look at this one, this is obviously the yen or USD yen. And now we saw the big price action in this pair obviously come on Tuesday this week here in Asia when the BoJ decided to ease policy. I mean, just for those of you that aren't aware, the BoJ basically bumped up. Well, really two big things was they bumped up their assets purchase program by 11 trillion yen to 91 trillion. But at the same time, oh, by the way, this was just if you're interested, this was about 10 trillion of government debt, and the remainder, or most of the remainder, was in exchange traded funds, corporate bonds, and commercial paper, which isn't that significant, but it is interesting, and that starts to build up. All right, and the other big announcement was the establishment of a special facility to stimulate borrowing. Basically, what that is it's very similar to these sort of LTRO operations we saw in Europe. It's basically saying we're going to lend you money at very low-term interest rates to try and stimulate the economy, which is, obviously that's a big thing. If we saw that, in the two LTROs in Europe, we saw that, really pick up, and there was a big pick up in sentiment going through Europe. Again, the situation is a bit different in Japan, just because, the economic indicators there are definitely in the doldrums, and it's not looking good. We're definitely not suggesting, there's going to be a turnaround of the Japanese economy anytime soon. In fact, I think, the opposite. I think, as long as the yen stays at these levels, and this weak global sentiment feeds through into the export sector, it's just going to, Japanese economy, there's not much of a light on the horizon, in my opinion. We can see that as well coming through in the rhetoric from the BoJ and the government. If we looked at, I mean, what happened on Tuesday was also actually very unprecedented in terms of we saw the BoJ and the government sort of join forces and say, this broad sort of appeal saying they're going to help, both meet this inflation target and, defeat deflation in Japan, which is unprecedented. We've never really seen that before. Throughout the world, that's very uncommon. But again, we've never seen it before in Japan. So, I mean, that is good news. I mean, in a broad perspective, it means policy is going to be focused towards on both ends of it, from fiscal policy coming from the government and a monetary policy coming from the BoJ is going to be focused towards defeating deflation and getting that 1% inflation target. But again, that sort of highlights the problems in Japan. I mean, if the situation is that bad, they both need to jump in and start doing it, or start trying to get inflation going, then it definitely raises a few eyebrows. But it also creates an interesting situation where what are they going to do? So if we keep saying the BoJ go, what are they going to do, and what does that mean for the yen? Because as we know, I mean, one of the biggest problems for Japan is the yen. I mean, we saw, I don't know if you guys saw Nintendo come out, with the results earlier, but they basically said one of the biggest problems, the profit downgrade, one of the biggest problems they said was, the yen, this high yen is just hammering. So, I mean, that's not limited to them, obviously. That's across the board going forward. Now, the market is just not letting up. They're not letting that yen significantly devalue. Even when they announced that $11 trillion jump in the asset purchase program, we saw a flock to the yen. So it's almost like the market was saying, it was exactly like the market was saying, this 11 trillion is not enough. I mean, we know the situation's worse than that. We expected you to do more. I mean, the situation is worse than that. I mean, that 11 trillion, it's just sort of, it's doing the same thing and over again, expecting a different result. And I mean, what does that mean? Well, that's basically Einstein's almost definition of insanity. So it's not good. The market was very wasn't happy by that. It doesn't bode well for Japan going forward. But again, when they came out with this sort of joint statement and our fiscal and monetary policy going in the same direction, that will bode well, at least in the long term. We should see a pickup going forward. But what does this mean for the yen? Now we expect to see further easing going forward from the BoJ. I mean, that's pretty much a given that we need to, they know they've got to meet this inflation target, and the way to do that, obviously, they need to keep easing. Now that will devalue the yen, but again, the market is also expecting that. So from a long-term perspective, it's not all that important for this pair going forward, because the market is expecting it so much now. Especially if we look at the chart today, when we actually got really bad results from Panasonic earlier, and that basically the market then sort of said, okay, right now the situation is really bad in Japan, so we're going to get more and more. But again, even that it only pushed the yen up by sort of 20 pips or so, the US yen, and then it came down a bit. So there's not enough there, or enough easing. There's not going to be to materially weaken the yen to benefit the Japanese economy. At least if they just keep doing what they're going to do. So that should be very interesting going forward. But what does that basically mean? I mean, this 80.3 from a technical perspective, 83 to 84 is going to be very hard for the yen to break. Again, we always know that that 80 level is very sticky for the pair. We saw that a bit earlier. I mean, right now it's it sort of popped below, and now it's just sort of popped back up to 80. That it's always been a sticky area for the pair. But if it does get above that 80.20 again, it'll open the door for 80.30, 80.40. But beyond that, it is pretty limited. In fact, we expect it to hover around these levels going forward. If we do see more disappointment, then there's definitely the possibility of a push towards 78-ish, maybe 78.30, somewhere around there. If we don't see that policy action, especially going forward from the BoJ, from a government perspective, it's not as important because it doesn't always directly impact the yen. But again, if it does, if the policy starts to focus on that, then there is the possibility of a weaker yen. But that's a bit up in the air at the moment. All right, so this is the New Zealand, obviously the New Zealand yen. This is a very interesting pair. I've just been looking at this for the last week or so. Now, the thing about this, obviously, from a fundamental perspective, there is calls for the NZD to the RBNZ or the Reserve Bank of New Zealand to start cutting rates again, or at least lob another 25% off the headline cash rate. We don't think they're particularly going to do that. So it does create, the market doesn't particularly think they're going to do that. But if the situation starts to get worse, then we expect that to happen, and that will obviously be a weakness for the yen in terms, for the Kiwi. So that'll create some downside, for this pair. If this is, by the way, guys, this is a daily chart, so this is more long term. So that will create some downside. Now, on a technical perspective, as you can see here, is obviously a rising wedge. Now, rising wedge is in this sense anyway, is a bearish indicator. So, we want to, we expect it to see a push lower. Now, but it's not only that. The thing with the rising wedge, you've always got to keep in mind, obviously, it's only bearish once it breaks the lower band of the wedge. So, but we do expect the technicals are pointing in that direction right now. But if you're really into getting into aggressive in your trading, then you could probably looking at these levels. But otherwise, wait for a confirmation breakout. Below the lower band. Obviously, confirmation breakout. We want to watch. It depends. If you do use candles, watch the candles. Make sure you get a confirmation from them that we actually are out of this rising wedge pattern, which we think we will get. But again, I'm going to be keeping an eye on this in coming weeks, because it's not it's not going to be something that's going to happen right away. Obviously, this is a daily chart. All right, so the next one we're going to have a look at is the EURGBP. So this was actually a very interesting pair. We went over this last week. We saw obviously that pair come up. It came up and hit that 50 level as we went over, and then it just sort of started retracing very nicely. So it basically created almost a double top for itself. As we can see, it bounced off that 50 level here and here, and then it just started to come down fairly nicely. Again, that's what we'd expect. Now, what can we see? Obviously, the MACD and this RSI included didn't jump into massive oversold territory, but again, we start to see sideways or flat price action. So what do we expect? That tells us maybe in the near term there's a chance for a bit of retracement, but again, we don't think it'll get above 80.70, 80.75. If it does, that'll rule out the possibility of more downside in our opinion. So as long as it stays below those sort of levels, we're looking for more downside, especially towards 80. Now, if we see a confirmation break of 80, then that should pave the way for an even lower push. But that 80 level is going to be very key for the pair. If it does get down there. But again, we want to, in terms of when we get in, I'd possibly watch out for retracement. But if it does, and it sort of starts bouncing off 80.05 or whatever it might be in terms of 80.70, then that could be a definite opportunity to look at the pair to get short. Although obviously, again, watch the technicals, make sure you got your stops, make sure you got your right risk strategies in place in terms of trading that pair. Obviously, if it does, like I said, break above that 80.75 level, that should be fairly worrying. Now we're going to go over gold again, just because it's one of my favorite trades. Now, the big reason, obviously, there's so much talk about this right now, is because there's been a lot of unwinding of gold, especially from a few key central banks, India and what have you. Now, the upward trend, as I went through last week and the previous, is basically that that was a lot more hoarding going on. So we saw a lot of big guys like India and the PBOC jump in and start to buy gold, and that was very interesting. And obviously it pushed the pair towards 180. And as we suspected, it didn't break that level. It was just 1800 was too much of a resistance level for the pair to get through, and retrace through and bounce off 38.2, as we can see there, around 1700. And bounce back up. So that should be very interesting going forward. Again, like I said, there is that possible for a bounce up, as there always is, towards 1750. Technicals right now aren't definitely on the downside, but we think overall there is more weakness. We think from a fundamental perspective there is this chance of more central bank unwinding of gold, which should create a bit of downward pressure on gold, especially against the USD. So that should be fairly interesting, especially if we do see that sort of start to pick up momentum, then we think possible people might jump on the bandwagon and get going in that. Yeah, sorry, quick question. Go through. Will the extent of the USA storm require a sell-off of gold to fund recovery? Not particularly. I mean, we're looking at the estimated recovery costs of that terrible storm in the US, which is Superstorm Sandy, is around 20 billion or so, which it can obviously come from the diversification of assets, or they can fund it any way they want, but we don't think that's going to have a great effect on gold. I mean, there might be effect on the other side in terms of USD, USD funding, or infrastructure spending, trying to build up the economy again. But overall, it's not a massive economic number, so we don't expect to see a big impact, from that side of the equation. At least we think again it'll probably be driven by the central bank, or at least sentiment action going forward. But again, the big thing to watch out for, any time with gold, no matter what pair you're trading, is but especially against the USD, is QE in the US. If the Fed all of a sudden announces they're going to need to jump on the printing press a lot more than the market currently anticipates, or a lot more than they've expected, then that is going to be a big drive for gold. Gold is the biggest reactor to that historically, and will likely continue to be going forward, especially against the US dollar, as it's directly correlated to obviously printing of US dollars when they start buying mortgage-backed securities or government securities, wherever they might be. That'll feed definitely into gold from a fundamental perspective, and that'll outweigh other factors. Now, a lot of that was priced in, obviously, when we saw that big hype up towards 1800. But again, some of that hike was because of central bank action elsewhere, not just the Fed pricing in, which was a lot of commentators are saying the QE effect of gold, which has pushed it up to unsustainable levels. But there were other fundamental reasons behind that push higher. But again, that we think once that starts to unwind, we should see some very interesting price action going forward. Okay, now that's basically it for the preferred stuff. Actually, sorry, no, this is the interesting action. This is the interesting chart here of open interest in gold. Now, open interest basically means open interest in gold. It's pretty self-explanatory, just what the sort of interest is in gold right now. In terms of the market. Now, we've seen this nice this push lower, obviously, in open interest. Now, when we see this is more of a leading indicator if it's an indicator. So the underlyings of this, it does back up our theory of there is room to create gold. This sort of open interest story doesn't, direct price action, which you can see if you plot it against gold, but it does create the room for downward movement. It doesn't necessarily dictate that there's going to be downward movement, but it doesn't prevent it at the same time. So it's something I always keep an eye on, in the back of my mind and look at going forward. But again, that sometimes does change that equation of open interest v gold, especially in times of high uncertainty and things like that. But we definitely want to watch that going forward, and I'll keep this graph in the back of my mind to make sure it still provides the opportunity for downwards movements. Okay, so that's pretty much it for the prepared stuff. Obviously, just to recap, we obviously went over the RBA, the BoJ, we went through the Chinese PMI data. Right now, as I said, there is that possibility for a break of this ascending triangle pattern up for the Aussie in the near term. Like I said, the daily chart does provide room for that as long as you can get through the bottom of the cloud base, which again, if it's perfectly in line, the bottom of that cloud base is perfectly in line with the top of the ascending triangle here, around 104. So that's going to be key to go forward. I'll definitely be watching that. The yen, again, that we think there's still going to be some fairly sticky action in that, in terms of we don't think it's going to be big movements in terms of 100 pips, but there is that opportunity if we start to see disappointment in the long-term flow through, that it might come through and lead people back to the yen. But again, if things start to get really bad in Japan, and we start to see even worse figures, which it would be hard because figures are pretty bad right now. But if they start to get really bad, again, market will start to anticipate more easing, and obviously that will that will lead to selling off at the end. But again, the things have to get pretty bad for that to really happen. All right, and again, NZDJPY, as we can see, rising wedge, as we know, is if you guys have studied Murphy's stuff, is bearish if it pops through the bottom of that trading range, which the technicals look like there is that opportunity. So that pop through here again. We're going to wait for a confirmation around here, and then we can see a push lower. Now, the thing with the rising wedge, it doesn't stipulate where the price action will go. You obviously want to watch your main key support levels, or be it on a retracement resistance levels on the way down if you're looking at longer term trade in that, and definitely keep your stops open, because anything against with a commodity currency and a super safe haven asset can be very unpredictable sometimes. Again, with on the EURGBP, like I said, we got hit here. We came down, and again, now there is opportunity back up, but if it does get around here, there is that possibility of it heading back again towards 80. This level is going to be key, like I was saying. So watch that going forward. And again, with gold, we think again possibly up here, but overall, we're looking in that direction. Again, these levels always provide some interesting price action and possible retracements for the pair. But I'll keep going on this as it goes forward. So yeah, that's about it from me, guys, on the Fed stuff. If you guys have any questions, feel free to ask. Otherwise, thanks for attending. I'll stick around for a minute or so to see if anyone has any questions. Cheers, guys, and yeah, like I said, I'll stay around for about a minute or so. Okay, Pate's got a question. Any opinion on the Aussie SPI? I haven't been looking at that of late, so I don't want to give a definite answer. But I'll tell you what, I'll have a look at that over the next coming week, and I'll definitely go over that next week. Just let me put a note down. I usually obviously keep a very close eye on this. It's just there's been so much action elsewhere that we don't want to get ahead of ourselves. But again, if you are looking at it, we want to focus on obviously the technicals, in my opinion, on this sort of trade. I really like technicals on the SX SPI. But again, I'll look at that and go over it next week. Anyway, otherwise that looks like it's it. Thanks for attending, guys, and I hope hope it was interesting. Otherwise, good luck trading, and hopefully I'll see you the same time next week. Cheers.